Aloha, this is Joshua Hayes of BigWaveTrading.com for your September 11th report. I believe today is Thursday. It is a day to remember the tragic day of 9/11, and I hope you all are in some way, shape, or form reflecting your remembrance. If you're not a fan of mine, but we'll just move on from that. Anyway, if we look today at the Dow Jones Industrial Average, we can see it actually had a minor bullish day today with volume higher than the day before and a very nice candle price action. It opens here, goes down a little bit intraday, and then rallies back all the way up to close near the high of the day. Now, it's at this battle line of the 50-day support average, so I expect some more fighting. But to have a couple of green bars sticking out here over red bars makes me think that it might be able to get to the 200-day moving average this time before failing. But the bottom line is, if we look at the longer term chart, volume here is smaller than volume here, 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 or even here on those bottoming attempts. So this would be our weakest bottom try out of them all. The good thing is that the relative strength line is making higher highs before prices, and so that does give you a short-term boost of hope for this. Now let's go on to the New York Stock Exchange and show that it is nothing, but it is still downtrending 50-day moving average with the 200-day moving average above it, and it has been pretty nasty since October. And on this bounce is on lower volume than all the other volume that you saw on the other bounces. So this proves that this will be another weak bounce attempt, and today's positive candlestick action comes with actually lower volume. And lower volume, as John Ward has always known, doesn't mean that it's going to be a good rally coming up. If anything, I expect more selling after a lower volume rally. If a lower volume rally here, it went nowhere, and if we start another lower volume pattern of lower highs, I assume that we're going to have the same pattern in the New York Stock Exchange. Let's look at the S&P 500, which is a similar index, to see how it is. And it once again had a nice day and actually closed near its high of day, but the problem is, once again, lower volume. I'm sorry, folks. With an index below the 50-day moving average and the 50-day moving average below the 200-day moving average, which has been the cost ever since the death cross in December and almost death cross in October. But as you can see, it stayed below the 50-day moving average, got above it in April, May, but couldn't break out above the 200-day moving average, and is now steadily holding the 50-day moving average lower. This is not a good chart, and this is not an index to be going long. So if you're looking for S&P 500 stocks to go long, stop it. The next index we're going to look at is the NASDAQ. Now, hopefully we can bring that up. Darn it, I'm not going to have my others up immediately. And then we have the NASDAQ, and it shows it had another nice day. Could be forming a bottom, right? You say at the old lows. But volume, once again, is barely above average. When volume is like in June here, this much further above the 50-day volume average on an up day like this, which it was even weak at 1.32%, it would have to be a 3% or more day. More like this with the volume like this. But in January, but instead happening now, not at the beginning of a downtrend. So that's what you want to see, and that's what we need to see in the indexes. Let's look at the last index on the day, which will be the S&P 600. As you can see, the S&P 600 has a bullish tail. The S&P 600 has retaken the 50 and 200-day moving average. We don't know if it was on lower and higher volume, as I don't get the volume readings. The only good news I see out of this is that while this is still making lower lows, the relative strength line is starting to move up. So, if anybody's talking about a rally coming, don't think it's going to be much more than an oversold bounce. These charts are still very ugly, and as you can see from the downtrend from all of these charts when I bring them all up, that's the New York Stock Exchange. This will be the S&P 500 coming up. You know, this will be the Dow Jones Industrial Average. And this will be the NASDAQ. As you can see, the exact same thing. And that's why stocks are doing bad. They're staying below the 50-day moving average, they're failing at the 200-day moving average, and then they continue below the 50-day moving average on all of the indexes. Until that changes, until the indexes start to re-rally above the 50 and 200-day moving average, and they can get the 50-day moving average over the 200-day moving average, like it even was in September when you did have some rough sell-offs and some stocks that failed a lot. But that was a hit at the top. But if you would have done this move back in, boy, I can't even put it up because it's so far back. Let's go back to 2003 and 2004 and show you that. When you have an index that looks like that, then you can go ahead and go crazy with your buys. You're going to have a lot of pretty stocks like this in there, and it won't be hard to not buy your new rally. So that's Joshua Hayes here with part 1 of the BigWaveTrading.com index. In part 2, I'm going to go over the longs, and in part 3, I'm going to go over the shorts, including on how to teach you how you could have avoided Lehman all the way down, just like I taught you about Fannie Mae and Freddie Mac. I may make it its own video, so we'll see what happens or how long time goes. Thank you very much.